Thank you so much. We are very excited to be here, and we know this is like the last week of filing taxes. So a lot of us are now um, in that mood of learning more about taxes.
Yes,
It's
that's right.
usually at this point where we are all on our toes and wanting to understand more. So just an introduction. I'm Rushina. I'm from Mumbai and currently living in Hubli. And Komal here is from Bangalore. And both of us started this firm Rupico just a year before COVID. Um, it has been an interesting journey so far for us. But before that, I would just like to share some experience of why we are doing this and how it all came about. So, both of us started our careers in a CA firm, like we are both CA aspirants, and we started working at a young age, like interning in a CA firm. And back then, it was very common to just see people all around us very much into finance and understanding finances so brilliantly. Like I remember I was 19 when I joined, and I would see my colleagues having demat accounts and shares, and it was very common knowledge, like common practice in a CA firm where there are so many CAs and everybody knows like they would be so up to date with the current finances. Like their routine would be coming to office and just turning on CNBC or whatever website they're referring to, and being updated on what's happening today, like which shares to invest in. And that was the kind of environment in which I started my career. So for me, I had developed this notion that this is very common, everybody knows it, and you have to learn it as soon as you start working. Cut to, I moved to Bangalore and joined a small startup. That's where I met Komal also. It was only the two of us on the finance team, and the rest of the team was a mix of people from different backgrounds, a lot of people from IT. It was a place where I, especially me, I started feeling like, okay, I don't know anything about what's happening in the tech on the tech front, because it was very different from what the kind of offices I had worked in the past. And people are very smart. They would know so many things about modern tech and very up to date on so many things. I literally would sit down with a notebook and write the terms, like what is SEO and what is this website built on and things like that. But there I saw that we faced like Komal had seen multiple tax seasons there in that office. And when I saw people, it was like people would come up to us and ask really basic questions like, where do I see my PPF interest, or how do I check my PPF passbook, or which is the mutual fund which will help me in saving taxes. Like it's called a tax saver mutual fund, it's that simple. But people would ask all these questions, and that's when we realized that this is, if you are grown in an environment where people are constantly talking about finances, you learn it very quickly. But if you're not, you have this entirely opposite mindset where you feel like it's very difficult and we will never figure it out on our own and we will always need help. And with that kind of a mindset, it's not going to work, because this is something very basic. We have to deal with it eventually. And so we have seen like two extremes of people. And over the last 2 years, we've seen that a lot of these things are changing very rapidly. Like in the first year when we started Rupico, it was very hard to like host a session and get people to join in, where like because they were not very curious. But in the last 2 years, with all these content creation around personal finance and so many YouTubers doing this kind of content, and so many reels on Instagram where they give quick tips on how to do this, how to do that, we have seen like a big shift in especially the youth, where everybody is at least trying to learn. And which is like really amazing. And like last 2 years, 2.5 years, we've been doing just sessions around finance and more curated sessions where we talk more about the mindsets and how, because personal finance for everybody is very different. There's no like a set standard that this is the steps that you have to follow, although there are, but it's still very person to person. Like everybody has a different emotional quotient, and that's why they react to certain things in a different way. Like if the markets are down, everybody has a different kind of reaction to that. So we've been doing more curated sessions around those topics. Uh, Income tax is one topic which is more straightforward. Like there are no, it's just a compliance that we have to do it, and there is no two ways about it. Like you have to do it, whether you do it on time, after time, like you procrastinate for a long time and do it. It's you can't escape it. So uh, this session will be more like facts and just understanding the different sections, the different forms, and what has to be done and what all one has to know as an individual. That's enough. Like although the act is really long, we don't have to know everything, because majority of the income tax act is for businesses. Like those are the chapters which are really lengthy, but as an individual there are only few things that one has to know, like the basics, unless we are entering into very complex transactions. So if it's only like a salary income and couple of other investments, it's actually very basic. And to just make it clear how basic it is, in a CA firm, usually the first and the second year articles are given individual income tax filing. Like the CAs don't even do it because it's very easy to do it. So everybody can file their own returns. That is what we've always felt, like it's not complex. And with the kind of uh, developments the department has been doing in the last few years, they have made it extremely simple to file it. So um, even if you need help in the couple of years in the beginning, or only in the years when you have some complex transactions, apart from that it's very simple for anybody to do it on their own. So yes, with that background we can start the session for today.
Yeah, hi everyone. I'm Komal. Riddhi, thank you for the welcome, and thanks to Ensure My team for giving us this opportunity to do this session. I think what I want to just say here before we begin is, like Rushina said, just come in with the mindset that if Rushina and Komal can understand income tax, I can also understand income tax. So that's the mindset that we should have here. And by the end of today's session, we really hope that you do get there. Yeah, and I'll just hand it over now to Rushina and we can begin.
Yeah. So this is the agenda for today. We will cover the basics of tax. We will discuss the most common sections that one has to know. And we will give you quick tips in case you still have to file your return for this year, which you have to do it in the next 3 days only. We'll give you quick tips to file it on your own. So we'll keep it short, but we'll try and cover most of the things that are relevant. So there are two types of taxes, which we may know of, like direct and indirect taxes. Indirect tax is all those other taxes that we've heard of, like GST, customs, excise, any tax that we are not directly going and depositing to the government. So all of them are indirect. Like we are bearing the tax, we have to, like if you're buying something, we have to pay GST on it. So we are the consumer is the one who's bearing it, but we don't have to do the compliance part of it. So most of the taxes are indirect in nature, but there is this one tax which, as individuals or anybody who is earning an income, has to pay tax to the government, which is which has to be done directly. So that's why income tax falls under this category of direct tax. And it becomes our responsibility, our duty to do it. Now there is this notion, we have seen a lot of times, that there are people who come and say that my employer is deducting TDS, and um, they are doing that part, and I don't have to do anything apart from that. Like my employer is taking care of all the income tax related things. And it's not completely true, because it's not up to the employer. Like it's not their responsibility to file it, although some employers do give this additional benefit, or like a service to their employees, that they help in filing their returns also. But the fact that they have deducted your TDS, or they have asked you for your investments or proof of investments or declaration, like those things are not equivalent to filing your taxes. So even if they have deducted or they have asked you for multiple things, it is your responsibility to do it at the end. And nobody is going to follow up for that. Like the max they will do is remind you that you have to do it, but you only have to file your own taxes. So we have had people who given us this reason of why they have not filed in the past. So that's why this uh, we thought is relevant. And apart from the fact that it's our responsibility to file taxes and pay taxes on time, these are some of the areas where it's relevant, the income tax return, that the acknowledgement that we get uh, it is it's the only source, it's the only recognized proof of income that we have in this country. And for things like visa, we need that kind of a document. And so any developed country we go to, we have to produce more documents which show what our income is, and the bank statements are not enough. So that's why we need this for various visa applications. We also need it when we have to avail loans or any credit facilities from any banking institution. So that's again where this becomes the source or the proof of our income. And it's also that one time of the year where we actually can sit and review our finances. Like not many of us have this habit of doing it on a weekly or a monthly basis. So this becomes that one time of the year where we actually spend some time and understand what's going, plan something for the next year. So these are the various reasons apart from the basic reason why we should be filing our income tax. And this is just some stats on how like how many people in India are actually filing their returns. So in a population of 130 crores, only 10 crore individuals have registered on the income tax portal, which is really, really like shocking. There is so much potential for our country to grow and more taxpayers to come in and declare taxes. The number of returns for this year that have been filed is only 3 crores, 3.4 as of now, out of which only 2.7 have verified. So the usual statistics is around 6 to 8 crores people usually file it every year. And what you see here is as on today. So only 3.4 have filed as of now. You just check this portal. This is on the income tax website main page. If you just check it on, say, after the due date, you will see so many people would have filed it in the last 3 days. Like this number will go from 3.4 to at least 5 or 6, which just brings us to this understanding of how much we procrastinate this. I am not sure if you're guilty of it, but we've seen a lot of people, like we are really jam packed in the last 5 days because most of the people are submitting documents in the last 5 days. Like there's something or the other pending. And when we think about why somebody procrastinates, it's usually because we either find it difficult, the task to be very difficult, very complex, or we think it's very boring and it just stresses us out. And we don't see any instant gratification, like there is no joy in paying taxes or no fun in doing that. But if we think from a different perspective of that this is a compliance, it has to be done, it has long-term benefits. It's like we have to pay electricity bills, we know that. And whether we like it or not, we always do it quickly. And the reason is because the process has been oversimplified. We know exactly what to do. We don't have to go and stand in queues anymore. We don't have to find that invoice every month and put the number. Everything is auto populated. Like you just go on your UPI app and pay it very quickly. So that's the reason when I think about why we don't procrastinate a certain thing is because we know about it and we have experience. Like there is knowledge and there is experience, which makes a task very quick. In case of income tax, a lot of us don't have that kind of knowledge probably on what we are supposed to do, like what documents we have to get. So that part we will be discussing today on what all things we have to know. The next part is with experience, we will stop procrastinating it. Like the more we know about it, the more it will become like a simple task. Right now, maybe it feels like a complex thing to do, but over the years, it will become very simple. And it, like as soon as we get the form 16, we can file it the next day. It's that easy. So if you think you are guilty of procrastinating any tax related work, be it submitting investment declaration or proof, or filing the returns, or reaching out to your CA and following up, um, think about why you do it and try to break it down, and uh, just change this perspective towards being more on top of it and owning it, like filing it on time. There are a lot of benefits for filing it on time, because wherever you submit this proof, these things are always noted on whether you're filing it before or after due date, be it visa, be it loans. Um, Apart from that, you also save on the penalties. So there are penalties now, which if you file late, you have to pay. Also, for all these years, we have always seen that the due dates get extended. But the last time we saw, it was extended once at the very beginning, and then it never got extended. And this time also, there is this news, or it going around, the talk going around, that it probably won't get extended. So um, it's a good thing in a way, because now it is making us more disciplined. Um, so don't wait for the last moment to do it. um, so we'll start with the income tax uh, agenda. um, when we talk about income, there are various sources of income that from where we earn. It is not just salary, but there are different sources from where one can earn income. The Income Tax Act has divided into five different heads, which is salary. Then the next is house property. House property would mean any rental income you're earning from any house. So that is the second head. The third one is the biggest head of income, which is profit and gains from business or profession. So this is where things are a little more complex. Like salary, house property is very straightforward. If somebody has their own business, or is in a profession of something, providing services as a freelancer also, all of them come under the third head of PGBP. The next is capital gains. Capital gains would mean profits or losses arising out of any sale of asset. So if you have any asset would mean like property or shares or mutual funds or any other asset. On sale of that asset, whatever gains are coming, realizing out of that, will come under the fourth head, which is capital gains. And the fifth one has all the miscellaneous kind of income, like interest income earned, interest on FD earned, any other miscellaneous income, like say lottery or prize money or anything else. Um, Even in some cases, like say you have salary as your main source, but you are taking tuitions on the side, or you have a side income from say YouTube or some content creation, anything, everything will come under the last head, which is income from other sources. So all our income will fall under one of these five categories. And when we are declaring, like filing the income tax return, we have to do like we have to think of all the income we have received in the year and show everything. So usually we refer to the form 16. If you're employed, you may have seen a form 16 or heard about it, but that doesn't have all your income. The form 16 comes from your employer, so the employer doesn't know all your other income, like FD interest or savings account interest. So you have to figure those things out on your own and then file the return. So it's not just form 16, there are all these other sources of income as well. The five heads of income have certain deductions within them, like certain things, like if you have salary, say whatever is your salary, you get the standard deduction of 50,000 every year, wherein it's just a standard, whether your salary is 2 lakhs or 20 lakhs or 2 crores, you just get 50,000 as a standard deduction. So this is for everybody. Apart from that, you get HRA or PT, and we'll discuss those things. So every head have there are some exemptions or deductions within each head. For example, again in house property, if you earn a rent, there is a standard 30%. So say if you're earning 10,000 rent per month, you can reduce 3,000, which is assumed to be maintenance of that house or just expenses incurred to earn that income. So that you can reduce from there. Same with business and profession, with other sources. With all of them, there are certain exemptions which are allowed within the same head. Then you arrive at a gross total income. And from there, you also get additional deductions which are applicable to everyone. Like whichever source of income you're earning from, you get certain deductions which you can always claim. And this is where most of the tax planning happens. Like if you want to save on tax or reduce your tax liability, you have to know what all deductions are beneficial to you, can help you, and you can save on taxes in that way. After those deductions, so we'll be discussing the deductions in detail. The heads of income, we will just discuss salary more and capital gains to some extent, because these days many of us have mutual fund sales or shares or things like that. So we'll be discussing salary, capital gains, and the deductions part from here. After deductions, you arrive at your total income. So that is your actual net income on which you have to pay the tax. So once you arrive at that, you have to just calculate. We will show you the tax slabs which are there, but calculating is not that difficult. Like you can, income tax website has a lot of calculators, so you can just calculate your tax liability there. Then there is this part called as TDS. So TDS is nothing but tax paid in advance on your behalf by your employer or by anybody who's giving you income. So the idea of TDS is just that this whole tax thing we do once a year, and tax is the income tax is the main source of revenue for our government. If the government receives the revenue once a year, it becomes really hard to manage it for the entire year and sustain. So what's a more efficient way is that they keep getting this income every month. And that's why what they've done is they have identified all the sources of income where we get our income from, and informed them to deduct some tax in advance and deposit it directly on our behalf, so that they keep getting their income regularly. And for us also, it's easier that you don't have to pay the entire tax in one go. Instead, it's happening a month on month, so that towards the end you just probably have to pay some extra, or you may get some refund depending on how much advance tax is paid on your behalf. So TDS is also it's tax deducted at source. So the source is not just your employer, it can be any entity from where you're earning income. So for example, it can also be say bank. If you're earning interest on FD, TDS is also deducted there, only if the interest goes beyond a certain limit. In the current scenario, over 40,000. Only if the interest crosses that amount, the TDS is deducted. So um, so that's TDS. And the tax liability and TDS may not always be the same. So the tax liability is what we have to actually pay depending on all this income and deductions. Say the tax liability is 10,000, the TDS may be 10 or 5 or 15. It can be anything, because it's all deducted by different entities who don't actually know our actual state of income. So if there is, say, extra TDS deducted, you can only get a refund if you file your taxes. It's not like they will assume and they will refund it to you because there has been extra. You have to go and do that actual work of filing. So this is like the basic structure of how things work. We will come to the common, all the common benefits that are there. So the most common one is Section 80C, which I'm sure a lot of us are aware of, or we've at least heard of it somewhere. 80C is basically there are a lot of investment avenues given there, that if you invest in these avenues in the year, during the year, then you can claim up to 1,50,000 as a deduction. So say if I invest in a tax saver mutual fund. If I invest 40,000, I can reduce 40,000 from my total income. Then there is life insurance premium. So these are all the avenues that are covered under ATC. These are the most common ones. The list is really long, but these are the most relevant ones. Like ELSS is on top because that has a very short lock-in period of 3 years. Then life insurance premium is something that most people have. So that's here. Then there is home loan. If somebody has a home loan, the principal component of that home loan. So the EMI has two components, principal and interest. So only the principal component comes here. Then there is PF. If there is a public provident fund started by you, that amount also, and if the employer usually deducts PF, uh, the employer share and the employee share. So the employee share is covered here under ATC. Then if somebody opens a fixed deposit for 5 years, like any term deposit for 5 years with a bank or a post office, that's also allowed as a deduction. Then there's national pension scheme. So these are the most common ones that are there. National pension scheme also has an additional benefit. If say you exhaust this limit of 1,50,000, but if you still want to invest more, you have that capacity to invest more, you can put it in NPS to get 50,000 extra. So the total deduction can go up to 2 lakhs with additional investment in NPS. So NPS is a very relatively new investment avenue. It wasn't there back in the times, but um, like we figured that private employees are not usually getting pension, and only the government employees are getting pension. So now we have this NPS started by the government, but we can invest similar to PPF. We can invest here and we will get a similar, depending on how much we invest till the age of retirement. Post retirement, we get a certain monthly pension from that, from our own investments. So it's a good scheme to invest in for considering long term retirement and all. So that has an additional. So when we see here, a lot of them are very long term in nature. It's also because the Income Tax Act tries to encourage things that they think are relevant. So if they think all this will encourage people to save for long term, all this is in the list. Then there are a lot of benefits related to house property, like around a home loan and stuff. So one is we discussed, if we have a home loan, the principal component comes under the ATC limit of 1,50,000. The interest component has a separate limit of 2 lakhs. So usually, if say the EMI is 30,000 per month or 25, um, every EMI will have two components. So the wherever you have the loan from, they usually give a tax statement at the end where they divide the principal and interest, and you can claim both of that in different sections. Um, then there is this ATGG, which is again a relatively new section, not very new, it's been there for some years now, which is for people who are either not employed or are employed but don't have HRA as a component in their salary slip. So we've seen certain employers don't have, like they just have basic salary and that's all. There is no bifurcation into basic salary plus HRA, other allowances and so on. So in that cases, if you're not receiving HRA from your employer, you can't really claim the HRA benefit. We'll talk about what is the HRA benefit, but in that case, there is a separate section called ATGG wherein you can claim 5,000 per month. So it comes to 60,000 per year. Whether your rent is 10 or 15, if it's below 5, you have to claim it below 5, but it's usually going to be above that. But the max limit here is only 5,000 per month. So if somebody is not employed working as a freelancer or a professional, then they can't get the HRA benefit, and for them this is the useful one. And HRA is only for people who are salaried, and if they are getting HRA as a part of their salary, then they can claim that it has a slightly like you have to calculate it. So there is an HRA calculator on the income tax website, wherein you just have to put your basic salary, your actual rent paid, and the actual HRA received. It will tell you how much is exempt. So, and also depending on the city. So for the metro cities, it's slightly more. For non-metro cities, it will be slightly less. So depending on that, the HRA will be calculated. And these are some common benefits that may help you reduce your tax to a very great extent. Like HRA especially, it can be a lot more considering living in cities is very expensive. So it's very useful to claim these allowances. And apart from the investments, the home loan and the house related deductions, there are also health related deductions that we get. Um, the first one of them is mentioned in section 80D, wherein if we say have a health insurance, the health insurance premium for self, spouse, and our children is up to 25,000 per year, and for parents it's separately. So the condition is we have to be paying for our parents if we want to claim that, and for our parents it's 25,000 if they are below 60. It is 50,000 if they are above 60, and if everybody is above 60, then it's 50-50 for both. So we may fall, assuming all of us here are below 60, we may fall in the first or the second category, depending on our parents' age. So the max benefit that we can get here is either 50 or 75,000. Another thing to note is if the parents are above 60 and if they don't have a health insurance, which is quite possible, um, but there are obviously some medical expenses or the other in the entire year, then only if they don't have a health insurance, they can also claim the actual, like you can also claim the actual medical expenses incurred up to 50K. So that is if the parents are above 60 and don't have a health insurance. So this is really.
So, just to add one more point here, within these limits, there is a 5,000 limit for any preventive health checkups done. So that 5,000 limit is all within these 25 and 50K limits.
Yeah, so this is like the max we can claim. Then there are these other sections which are not very commonly seen around, but these are when somebody in the family has a severe disability and they're incurring a lot of medical expenses. So there are different limits for each of these sections, but in case there are, you can just go online and check 80DD, DDB, and 80U, depending on who's paying for. If the person who is disabled in any way is paying for their own treatment, then there is a different section. If the person who, if somebody else from the family is paying, they can claim it under a different section, but there are benefits allowed here. In this case, you may have to get certain certificates from the medical professional as well. So yeah, this is something you can check if there is anybody in your family going through any other medical issues which is not just like you can't cover in the above 80D section. So yeah. And then apart from these, there are more tax benefits, which are one is interest on education loan. So for higher education, if you have taken a loan and if you're paying interest on that, you can claim the entire interest amount as a deduction. There is no upper limit here. Then there is interest on loan taken for purchasing an electric vehicle. So if you are purchasing an electric vehicle on a loan, the interest amount of that loan is allowed here. The max is 1,50,000. This, if you see that, it's basically the government in a way is trying to encourage sale of electric vehicles and people to consume more of that. So that's how these sections come in also. And the next is donations. If you make any donation in the year to any NGO or trust which is registered under the Income Tax Act, you can claim 100% of the donation amount or 50%, depending on which charity that is. They usually will, like, they have to give you a certificate, which is an ATG certificate, wherein, like, because while filing the return, you need all the details of who's the organization, what is the PAN of that organization, how much is donated, and so on. So if you make any donations, you have to make note of this as well. So that's basically all the deductions that are available. Once you reduce that from your total income, you come at the net income, on which you actually have to calculate the tax. So there are these slabs, which makes it more fair on, like, which, it's not like a flat rate. So there is again this misconception on, if say your income is 12 lakhs, you have to pay 20%. It's not really that. It goes progressively. For the first 2.5, you don't pay anything. For the next 2.5, you pay 5 lakhs, and so on. So 2 years ago, we came up with this new and old regime. You may have seen it in this year, while like last year and this year, it prompts you, it asks you a question whether you want to go with the new regime or the old regime. So if you see the slab rates between the two, Komal, can you put the new one? Hold. The earlier ones was very like lesser slabs, 5%, 20%, 30%, that's it. And basically that would amount to more tax. The newer regime has a lot of slabs, which makes the tax liability lower. It reduces the tax liability because there is a 10, 15, 20% slab also in between. And over 15 is 30%. Here over 10 is 30%. So obviously the new one looks more inviting and appealing, that you would have to pay lower taxes. But the new one comes with a lot of terms and conditions, which is that you cannot claim any of the deductions that we discussed just right now. So you just have to take your full income and pay as per this regime. No HRA, no deductions of ATC, D, all of that. No standard deduction of 50,000, just nothing. You just have to take full income and pay tax. So this is usually beneficial for either freshers who have not yet planned their taxes and don't know how to go about it, or if the deductions that you're claiming are very low, like if you're investing in different places, not the ones that are mentioned in ATC, and if you feel that that is more smarter way of investing and you don't want to do it as per the Income Tax Act, then you can opt for a new one. So you, if you're salaried, you can shift between the two. But if you are non-salaried, say for example, you have like freelance income, professional income, you can only switch once. So you have to be very mindful of which regime you are selecting, because you cannot keep on switching it year on year.
The new tax regime is also sometimes beneficial for those who fall under the 10 lakhs and above income category, especially if, as Rushina mentioned, you do not have too many deductions or investments that you have made to claim. So even if you're falling in the high income category, it's advisable to just compare your tax as per the new and the old and see which one is more beneficial to you based on your investments.
Yeah. And then apart from that, for capital gains, the taxes are slightly different. They don't always fall under these slab rates, except for just one. So first of all, when it comes to capital gains, there is this bifurcation of debt and equity, like equity and non-equity. That's how they call it. Equity is basically equity shares and equity mutual funds. Any other asset apart from that, for example, a debt mutual fund or property, will come in non-equity. So there is this bifurcation. For equity, the short term and long term is also different. So for equity, for example, shares, the short term is 1 year, long term is beyond 1 year. So if you sell something after a year, it amounts to long term. But for debt, the short term is up to 3 years and long term is beyond 3 years. So an easy way to remember is, for say for example, if we buy a property, the short term has to be like 3 years, because for a very big investment like property, we would say short term is 3 years, and if I sell it after three, it's long term. But for something like shares, where you are also dealing like month on month, also sometimes you would buy and sell, sometimes in a year you would buy and sell. So there, the short term is only 1 year, and long term is beyond one. This is important to know because the tax rates are different for short and long term. For equity, if you sell very quickly in a short duration, you have to pay a higher tax. So this in a way is kind of discouraging you to do more trading and short term transactions. Equity is meant to be for longer term, so longer term the tax benefits are also more. If you're selling anything within a year, you have to pay 15% on the profits made. If you're selling after a year, you have to pay a lower tax, and that too with this added benefit that for the first 1 lakh, the 1 lakh rupees of worth of profit won't be taxed at all. So every year you get this benefit of 1 lakh, and only if the profit crosses that 1 lakh, you have to pay 10% on it. So a lot of benefits when you hold equity for a longer term from tax perspective. So that's why if you are wanting to sell something, and if you've reached like 11 months, it's always better to wait for another month and then sell something. And ideally, when you invest in equity, it's always recommended to hold on for say 5 to 7 years and more. So yeah.
We have one quick question which I'll take now because we are on this topic. Mutual fund gains are taxable as per capital gains tax slab is the question.
Yes, so this is how mutual fund gains are. Only debt mutual funds, which is short term, is as per the tax slab. So you see the bottom row wherein if it's debt and if it's short term sold within 3 years, then it will be as per the tax slab. If it is beyond 3 years, then it will be at 20%.
Yes, so one clarification here regarding this slide that you're seeing right now. Capital gains tax, as Rushina mentioned earlier, you earn the capital gains when you sell an asset. What we're covering here is mainly the asset of mutual funds or shares. So this is the only thing we're covering here right now. We're not covering capital gains earned on sale of a house property or anything, but even that would come under this capital gains taxation. So it would come under this head of capital gains and would be taxed as per the provisions of the Income Tax Act.
Yeah. So this thing where you see 20% with benefit of indexation. So indexation is mainly adjusting your cost to inflation. So when this especially becomes very relevant for property, when you're buying a property for say 20 lakhs, after 10 years when you go to sell, the cost itself is a lot higher. It's not like you're making like say if you sell it for 80, it's not like 60 is your profit. The cost of that property has also come to say 50 lakhs in the meantime. So the benefit of indexation helps you change your cost, the purchase cost, adjust it with inflation. So again, there is a the formula which income tax department provides on how much inflation to calculate every year. They come with that index every year. So you can adjust your cost with that. Same with debt mutual funds, you can do that even there. Tax on ESOP, I will just cover in short. So when you receive ESOP from your company, there are 2 times when you will have to pay certain tax. The first time is when you get the ESOPs and when you actually buy the shares. The difference, like say the actual share price is say 100 rupees and you are getting it at a discounted rate of 80. So that 20 rupees is considered as your perquisite, which will go in salary. Like you're getting that benefit as a part of your salary in a way. So that's one time you will have to pay tax. And the next time is when you actually sell those shares. So when you sell those shares, there will be capital gains on it. So that's the second time you will have to pay. And that time you will consider 100 as the cost price because you have already made up for that differential amount. So you won't consider 80, but 100 as the cost price and selling price will be as on then. So this is in short about ESOPs. There are a lot It's not that complex actually, but it depending on how you're getting it, how you're like what are the different tools or how you're getting it, whether it's a listed company or a non-listed company, things may change to some extent. And then there is this TDS, which we discussed in brief previously. So again, like I said, it's not just the employers that deduct TDS, it can be any other organization also. When it comes to you being salaried, working as an employee, the tax that is deducted is actually as per the slab rates. Like that's why there is this whole process of your employer asking you for what investments are you making, what is your HRA, like how much rent are you paying. They ask you all of that to try and deduct as much tax that is actually applicable to you. So here, that's the reason they ask us for all these documents at the beginning of the year, at the end of the year, and all. But if you are, say, not employed, you're working on your own as a freelancer or consultant, then the tax slab will usually be just 10%. Like it will be a flat rate of 10%. And in that case, it is also possible that the actual TDS is more than what you have to pay. So there it's all the more important to file it on time and claim that. So that's not just consultants, but even bank will deduct that much, or anybody apart from an employer who's paying you any income. Say, for example, you're receiving rent from somebody. You have a property and you're receiving rent. So even there, the TDS will be 10%. It's mostly 10% in everything else, but for employee, it's as per the slab rate. So yeah, this is how the form also looks like in in short. Like this is the structure of how the income tax form is. You have to select which all sources of income are applicable to you, add all the deductions that you've wherever you've invested or whatever you want to claim. The total tax liability will come, the TDS. So a lot of these things will be auto populated on the website since they have now linked our PAN with Aadhaar with bank statements. So everything is linked and they get the information from all these different entities, which you can also see. So this year onwards, there is an additional document that you can get on the income tax portal, which is called AIS, Annual Information Statement, wherein all your yeah, so this is the list of documents that you need to have if you want to file your own return. The first is Form 26S and second AIS. These two are available on the income tax portal. So when you log in on your portal, you will be able to find these two. Form 26AS has all the TDS related information. So whoever has deducted TDS on your behalf, or if you have paid any tax in advance. So if your tax liability is over 10,000, you also have to pay advance tax throughout the year if there is no TDS. So those things will show up here. Form 26AS is similar to Form 16 that you get from your employer, but it has limited information. It doesn't have like a breakup and all. It's just the amount received and the tax deducted against it. Then AIS is a new thing that has come in from this year. So if you go and check your AIS on the portal, it's under the services tab. You get a lot of information related to your banks and mutual funds and shares. So you get the bank savings account interest, FD interest, mutual funds bought and sold during the year, shares bought and sold during the year. So it's just like they have all this information, so we shouldn't be skipping on any of these because it's there. It's also auto populated, so the tax won't be calculated automatically. We have to put that, but the information is all there, so we can just cross check whether we have missed out on anything or not. So this document has to be downloaded beforehand so that we know to cross verify. Then Form 16 or 16A, depending. So Form 16 is what we get from the employer, which has a breakup of salary and tax paid and all of that. And in case you're a consultant where TDS is deducted, you get a Form 16A. So this has to be, this comes from your employer or from the source of your income. Then a capital gain statement. So basically, we saw that mutual funds and shares have slightly complex tax calculation. Like it's it becomes complex because you are buying on different dates, you are selling on different dates. You're say buying 5 shares today, 10 shares tomorrow, selling seven after a year, 15 after that. So it becomes slightly complex to calculate it on our own. So all of them will give us a consolidated capital gain statement. So it's just easy to go through it. You can get this from the place where you have your demat account. So say if you have a demat account with Grow or Zerodha, you can get it on that portal. If you have invested in mutual funds through these apps, you can get it from there. If you have invested through say different websites, like say for Axis Mutual Fund, you have invested through their website, you have to go on their website and get the statement. Or else there are these there is scams and Carby, which are like what do you say, the third party, uh, the intermediary for investing in mutual funds. So they, if you go on this website called Cams Online, they have, you just have to select the mutual funds you've invested in. You get a consolidated statement even there. It's very easy to find this statement. Um, Then you need to get interest certificate, which is if you have fixed deposits or RD from the bank. So this may also come up in your EIS, but it's in case your bank is not linked or something, or in case of certain scheduled banks, it may not come up. So you have to find that interest amount. And if you have a housing loan ongoing, you need to ask for an interest certificate from the bank from where you have your home loan. And ELSS statement is again available. It's basically, it will just have how much you have invested in a tax saver mutual fund throughout the year. So you can get it easily, or you can get an ELSS statement separately from wherever you've invested. An NPS or PPF statement just to see how much you've invested there. So once you have all these documents ready, handy, then all you have to go is like go on the income tax portal. The portal is very easy. Like when I think about it again, some years ago, or say 10 years ago, so Komal has actually been to income tax offices to submit the documents and you get a stamp on it and you come. It's no longer like that. It's just like how now we don't no longer have to go and pay electricity bills. So it's become very easy, just like any other bills or any other payments we do on a monthly, yearly basis. Income tax is also that easy. It's made very easy for you to just go on the portal. A lot of things will be pre-filled. You just have to check it, keep going ahead. And whatever is not pre-filled, you just have to add that. Yeah, one thing is you have to add all your bank account details. So that's in the basic information itself. Next is you have to select the right ITR form. So there are different forms depending on what is your source of income. Usually what is applicable for individuals is form 1, 2, and 3. One is basic if you have salary income, which is below 50 lakhs. And if you have other income from other sources and house property, ITR 1 is applicable. But in case you have sold any mutual funds or shares, and if you have capital gains, then ITR 2 is relevant. So usually 1 or 2 will be applicable to most of us. In case you have a business and you want to show business income, then ITR 3 is relevant. So I think that much information is enough. On the portal also, there is a, like if you don't know which ITR you are eligible for, they have like a list of questions. You just select what's relevant for you and they'll tell you which ITR form. And that there is a late filing fee. So the late filing fee is between 1,000 to 10,000. If you are filing it, say after the due date, which is July 31st to December, the late filing fee is 5,000. Beyond that, it's 10,000. And in case your income is low, below 5 lakhs of rupees, then the late filing fee is 1,000. So this is about that.
There's one question, which ITR form is relevant for professionals or consultants?
So if you are filing, if you're only receiving professional or consultancy income, then it will ideally be ITR 3.
Yes, basically you would be showing that as your business income if that's what you're doing full time. If your professional or consultancy receipts are just part time, it could be treated as a freelance income, which can be shown under income from other sources if it's not a huge amount. So it can go under income from other sources and then you can file ITR 1. But if you're treating it as your full-time work and it is a business, then ITR 3 is recommended.
So ITR 2 and 3 both have capital gains. So if you have investments or capital gains from there, it could either be 2 or 3.
Yeah, this is just a recap of the forms to take note of.
Yeah. Again, investment declaration and proofs are something that you have to give to your employer. It's okay if you sometimes miss out on it because you can always rectify it at the end. And this is again one common, like a small thing that when it comes to income tax, we usually talk in assessment years. So the assessment year is the year following the actual year. So April to March, say the last year, April to March was the financial year 21-22. So you are assessing that income and filing tax in the next year, which is 22-23. So currently we are in assessment year 22-23. And this is just a timeline on when you have to do what. So at the beginning of the year in April, your employer will ask you to declare investments that you're going to make for the year. You may have planned, not planned, but you have to declare it at the beginning so that they deduct TDS every month accordingly. In May and June, you usually get Form 16 for the previous year. So in May and June, you get it for the previous year so that you in June and July, you can file it the previous year's return. And then again in Jan and Feb, you have to submit proof of what you have declared in April. So in April, you say I'm going to invest 1,50,000 in PPF. In Jan Feb, you have to submit the proof. In case you don't submit, they may deduct TDS accordingly for the next 2 months. Like in case you declared it earlier but didn't really invest, they will deduct more TDS in the last 2 months. So that's all. So this is the timeline. We don't have to do too much work when it comes to income tax. It's very basic. It's very easy also. Yeah, to sum it up, you all have already taken the first step because you are here and open to learning and wanting to learn more about it, which is really great. And don't hesitate to ask questions. So now we'll be doing a Q&A. Whatever questions you have, feel free to just put it in the chat box. We'll answer as many as possible. And again, there are a couple of websites like Tax Guru or Clear Tax. They have a lot of articles around different, like smaller subtopics. So if you are all in like stuck anywhere, just go online, read up about it. Try and read up from 2 or 3 different websites because we've seen that sometimes there is incomplete information. So to avoid that, there is always income tax website to fall back on, but they have the language is a little more um, like formal there. On other websites like Tax Guru is one website where you see a lot of tax related articles and they are more complete. So yeah.
And if you have CA friends, you can always reach out to them.
Yeah. Okay, I'll just read the questions in the chat. Interest paid during pre-construction period of house property. Interest paid on your housing loan for current year has been. Okay, so when you have in like say you can start claiming your home loan related interest only after the house is constructed. But if you have been paying interest before that, usually it's divided in the next 5 years. So that you can claim in the next 5 years, and that's why I think they're asking you to fill that. I don't think that like there are errors because of that, or like it's usually a deduction that you get. So the tax should actually get lowered if you have any pre-construction interest that is not claimed.
There are also a few questions in the Q&A box.
Oh, okay.
There's one related to what is the tax structure for a consultant or a freelancer? Can they show 50% of income as cost in deductions?
So there, if you are a freelancer or a consultant, one way is to show. So it's you have to ideally show it under business and profession. One way to go about it is show all your income, show all your expenses, which is uh, like all the expenses that you have incurred to get this income, and on the profit you pay taxes. There is another section called 44 ADA, which in case you are um, going through it, you may need some help from a tax expert. So there is an option to pay, like directly assume 50% is your expenses and pay tax on the balance 50%. But you cannot. So it doesn't mean that you only show 50% of your income. You have to show it in under that separate section, which is 44 ADA, and show the full income, and it will automatically calculate at 50%. So yeah, there is that option as well. And the thing about 44 ADA is that if you opt that, and if in case next year you think of opting out of that, then you cannot opt in again for 5 years. So if you're choosing such things, you have to contact somebody, get some help from someone, because there are a lot of rules, like smaller rules, when it comes to business and profession, like I mentioned.
All right. The next question is what to do if you switched jobs in the same financial year?
One thing there is, when you switch jobs, ideally the newer employer has to ask you about your past employee, like past income, and they will try to consolidate both the like form 16 will have income from your past employee as well, employer as well. In case that's not done, then you have to manually just um, add both, like add both the incomes, and you can claim standard deduction only once. So 50,000 can be claimed only once, and rest of the things are normal.
So usually what we've seen, what happens is that your first company would have taken that standard deduction and calculated the tax accordingly. And then when you join your second company, even if you have declared your previous company's income, sometimes it so happens that they will again take that 50% standard deduction, and sometimes may not even include the previous company's salary in your new form 16 with the new company, which is why when you go to file your return, you will notice a higher tax payable because of this switch and this not accounting for the income properly. So whenever any of y'all ever switch jobs during the year, in the middle of the year, just make a mental note that there could be a tax payable when I file my return later on. And yeah, just make sure your investments are in order and you've have all of that ready so that you can get the benefit of. The next question is, what if we have losses from a sale of an asset?
So losses, if you have sold something and if you've incurred a loss, you can either, so there are different rules on what can be set off against what. So you can set off that loss against income from somewhere else, some other head. In some cases, it's not, like there are different rules. So say if you've incurred a loss in capital gains which can't be set off against other income, then you also have this provision to carry forward your loss for the next 4 to 8 years, depending on from where you've incurred that loss. And in case you have to carry it forward, then you have to file returns on before the due date, otherwise you cannot carry forward your loss. So the first thing is you can set it off against income from other head. But if it is capital gains, which is long term in nature, you cannot set it off against any other head, but against the same head. So in that case, you would want to carry it forward.
Right.
Yeah. Does cryptocurrency come under capital gains? So as of like until last year, there was no clarification on what it would be. It would ideally still be under capital gains because it's an asset. It's considered like that was what was going on, that they want to make it a digital asset, not currency but an asset. So it would come under that, but this year in the budget they said it would be taxed at 30%. So there's a flat rate of 30% on all the profits made. Then do we need to pay taxes on reimbursement amount received from employer? No, that's the reimbursement, so you don't have to pay taxes on that. And it will not even come in your form 16. So it's not considered as an income. If you have 2000 as speculation income and much higher STCG income, short-term capital gains, yes, it's okay to do that if the quantum. So here the question is asked because if it's a speculation income, it's sometimes to be shown as so there's this confusion whether it's your business income or your capital gains income. If somebody is in the business of doing intraday, they will have a very huge speculation income, and that has to be shown in business. But if it's only 2000, you can justify that this is not your main source of income and it can be taken under short term capital gains.
Okay, I think we have time just for maybe two more questions. Yeah.
Is gift taxed? Marriage gifts? So for gifts there are again rules. If it goes beyond 50,000, the entire amount is taxed. If the gift is received during weddings, if it's from relatives, then there is no tax on it. So um, only during weddings there is no tax. But if it's apart from that, if you're receiving gifts, if it goes beyond 50,000, then there is tax on it.
And one question regarding NPS. If amount is withdrawn from accumulated NPS investments before retirement while in service, then is it taxable? If yes, then is there a flat rate or is it taxed as per income tax slab?
I think it is taxable. I still need to check on it once. It is definitely not flat. It will be taxed as per the income tax slab. There has been talks on making it exempt, so I will check once and probably get back in some way. Because just like PPF, NPS also should ideally be exempt in every way, but currently some portion of it is to be taxed and some is exempt.
Right. Thank you so much, Rushina and Komal. It was such a great and informative session. I mean, I don't know what to say, but it was really like very informative, and we just kind of got so much information about what should be the reductions. So as salaried people, there's like a lot of confusion in our minds and what to do. But this was really informative. Thank you very much. I hope all of the attendees have got your answers for all your questions.
Yeah. So thank you so much for having us here, and you can reach out to us in these following ways, like on Instagram, or you can visit our website. And we have a newsletter which we share out on every Friday. So if you go on the website, you can sign up for that if you want more information. Like we share articles which are more relevant and no spam or anything like that. So
Okay, thank you so much, and thank you to all the attendees for coming to our event. Looking forward to seeing you at our further events as well. And again, a big thank you to Komal and Rushina for this really great and informative session.
Thank you for having us.
Thank you.
Thanks a lot.